This week we are going to examine long-term debt obligations and how they are handled. In your readings and assignments, you will interpret and apply the standards that relate to business-type transactions and proprietary funds. As always, do review the learning objectives for this week. As you complete the readings, assignments, and discussion, you will discover how the objectives stated by Governmental Accounting Standards Board are fulfilled. Recall GASB's primary objective, which is to provide information about resources and obligations, both actual and contingent, short-term and long-term. Information about long-term debt is significantly important to creditors, governments, and not-for-profits. Why is this? Governments and not-for-profits depend on debt to fund infrastructure, buildings, and other capital assets. And loss of the ability to obtain credit because of loss of credit standing, that is, failure to pay principal and interest, can inhibit the organization's ability to provide services demanded from its citizens. Notice the amount of debt, for example, of the two cities pictured here, City of New York and City of Houston. What is general long-term obligation debt? Debt is issued by almost every government. It is a liability, usually bonds, that are secured by the full faith and credit of the governmental unit. Most importantly, debt arises from the governmental fund's activities and are not accounted for in proprietary or fiduciary funds. We need to pause and levy up a caveat regarding this last statement about the recording and disclosure of debt when it is not a governmental fund's activity. According to GASB, if debt reported in a proprietary or fiduciary fund also has general obligation, that is, full faith and credit backing of the government, then the government's contingent liability needs to be disclosed in the notes to the financial statements. Let's illustrate this further by using the following state of affairs. Your city, using funds from the sale of $70 million in general obligation of debt, constructs a golf course. The golf course is a business-type activity, thus the golf course is accounted in an enterprise fund. The city anticipates that it will pay off the debt from the green fees. Based on the caveat just mentioned, should the city accountant report the debt as a governmental activity, that is, in the government-wide statement, and the golf course as a business-type activity? A reasonable case could be made that general obligation debt should be reported as government-wide debt inasmuch as it is a full faith and credit obligation of the government at large. Nevertheless, the GASB, looking ironically to the National Council of Governmental Accounting for guidance, suggests that the debt should be associated with the golf course, which is accounted for in an enterprise fund. The Comprehensive Implementation Guide also states, bonds, notes, and other long-term liabilities directly related to and expected to be paid from proprietary funds should also be included in the related funds accounts. The guide alternatively emphasizes that if the debt had not been expected to be paid with resources of the enterprise fund, that is, with resources of the governmental fund, and in our scenario, not the green fees, then the debt should be reported as a governmental activity and disclosed in the notes to the financial statements. When reviewing your financial statements, bear in mind that the accounting for debt in government-wide statements is fairly rigorous, recorded at face value or issue price, and the funds reported at present value. Let's return to a government and not-for-profit's ability to satisfy its debt obligations. Suppose a government fails to satisfy its debt responsibility. If this occurs, governments and not-for-profits can seek protection under the Federal Bankruptcy Code, same as individuals and businesses. You would agree that municipal bankruptcy does occur. More notable bankruptcy filings are governments that have attempted to enter into bankruptcy but were prohibited by the courts from doing so include Jefferson County in Alabama, San Bernardino, California, Central Falls, Rhode Island, and Harrisburg, Pennsylvania. To your surprise, likely, municipal bankruptcy is a more elusive concept than corporate bankruptcy, in that governments, in theory at least, can always raise revenue by imposing additional taxes upon its citizens and reducing expenditures by cutting services. Most major local governments have avoided bankruptcy by being put under the control of special state-mandated commissions. And some states even prohibit local governments from entering Chapter 11 bankruptcy. Irrespective, municipal bankruptcy was of sufficient concern for the GASB to issue its statement number 58, Accounting and Financial Reporting for Chapter 9 Bankruptcies. Do read more about this statement at www.gasb.org. Happy reading!